Hi everyone, and welcome to this month's version of On Track. It's the 31st of March as I record this, and apologies for the slight delay, but I wanted to get all the latest information in, including the budget and the latest on what's happening with world trade. So we've got performance numbers to the end of February. We're recording this on the 31st of March. As always, general advice warning, that just means those of you that I don't know, please seek out advice before you act on anything mentioned in this. This is designed for clients in Macquarie Wealth Management, and in particular those that use our care investment philosophy and portfolios. I'm going to cover off on all the news today. There's a lot going on in the world. The Trump administration is doing lots of things extremely unorthodox. I'll talk more about that as we go through, and the market's bouncing around a little bit. Nothing unusual in terms of market volatility, but it is certainly hogging the headlines as well. So very important that we put it all in perspective. And that great quote from Warren Buffett is always, the stock market is a device to transfer money from the impatient to the patient. At times like these, a lot of people run around like a chook without its head cut off, and they invariably lose money. So calm heads will make money in the long run. Let's have a look at the news highlights and the numbers. So markets, you'll see the chart here on this page. You see this is exactly a 6-month chart. So you'll see, and 6 months is takes us back to October. So the US election was about here. Market responded positively to Trump's election, down a little bit, then positively. And then, started thinking about the impacts of the trade wars and the tariffs in particular. This is a complex thing. Tariffs traditionally are bad for global economics, but people can get an advantage from time to time. And that's what Trump's trying to do, along with other things. So that's explained this market drop from peak to trough there about 10%. It's recovered a little, then gone down a bit. This is a big week. Trump's announcing supposedly more detail, so the market's waiting. Now that news will either be what's expected, in which case the market will not react, but it might be worse than expected, in which case the market might show a bit more weakness. Either way, it's all temporary along the way. In Australia, election was called for the 3rd of May. That meant Albanese and Chalmers, they'd handed down a budget a couple of days before that, before they called the election, 3 days before, last Tuesday, called the election on Friday. The budget was very uninspiring. They haven't addressed any real issues. Neither has the opposition. They're both battling over two different handouts. One, some delayed tax cuts, and the other one, a cut in excise. So they're trying to make it a popularity contest. Neither party are tackling any of the bigger fundamental issues. We've got deficits stretched for a decade. None of it's super bad because our debt levels are relatively low compared to other countries like the States. But it's just annoying that we're not taking advantage of good times to sort of tidy up the budget. But that's not the way the politicians are working. I think the budget is completely neutral to the markets, by the way. Much more impact is on what's happening in the States. And that global, so we've seen money fly from a little bit from the US into Europe as part of the tariffs, and some to emerging markets. All this is good. As you know, our portfolio is very diversified. So what we lose on one hand, we pick up a little bit on the other. I'll talk more about results and things in a minute. The US Fed, which is the equivalent of our RBA, very important in all of this. They reported last week, what was it, the week before? No rate cut, but they haven't changed their path to easing. They did note that the tariffs will probably drop growth. So they've lowered growth forecast from about 2% to about 1.7%, and they've increased inflation expectations from about 2.5 to maybe 2.8%. Powell did use the transitory word, which is kind of positive. In other words, he thinks that any impact of tariffs on inflation will be one-off transitory, so it will pass quickly. It's not going to be massive like COVID. This is going to be incremental. But it was fairly soothing for the market. That's when the market went up a little bit last week. Long run, RBA cash rate unchanged, still predicting, depending on who you read, anywhere from 2 to 4 rate cuts over the course of this year. 90-day bank bills reflecting that. 10-year bond rates have popped up a fraction but not a lot. I'll talk more about that shortly. Aussie dollar is very steady. It's bounced around just a little bit below, a little bit above 63 cents, but very steady. Inflation in Australia is in the band. We can see it's now in the middle of that 2 to 3% band, but it is artificially induced by about 0.5% from the little $150 bribe that the government keeps giving everyone with the power bill. So that's creating that low. We don't think it's an issue. US inflation under control. So inflation back in the right zones, which is a good thing. Mortgage rates yet to move substantially. A little move when the first rate was cut 2 months ago from 4.35 to 4.1. So mortgage rates, if you hunt around, there's a 5.64 out there. Mostly it's about 5.89, 5.9 to 6%. Worth chasing if you want any help with that. Yell out. Macquarie 1-year term deposits slightly weaker at 4.3%. So not too much changing there. Portfolio returns, very solid in terms of 10 years, bang on a long term. They're obviously down a little bit. You'll see obviously the 1 month down, but not a lot. So, you look at the growth portfolios down about 2 to 2.6%. In that month, international shares down about 3, Aussie down about 2. So diversification helping to cushion that, but we've also had some more of the downturn in March. So let's see if March closes as I expect to close today, we'll be down another 2 to 3% in March. But on long term, on track, we have lowered our dial because markets have dropped. If you recall, we had the dial up about 10. We're starting to get a little bit expensive. Markets much more closer to fair value with this little price correction. So that's a good thing. So you'll see that on the right here with that downturn relative to the last 20 years. I show this chart every month for a couple of reasons. One, so you can see the pattern of the wall of worry. So most of the time the market goes up, but with these little valleys of worry. So we can see, we've had 6 downturns, more than 12% since GFC. They're all things that we slowly forget about, but at the time they seem big. So downturns, fear of European crisis, global economy worsening. And we're making another little valley potentially at the moment. It's not down above 12% yet, but 10% is technically a correction. We have seen just touch on 10% before rebounding. So we're probably building another, what I would call valley of fear, which we call the fear of trade wars and all things Trump impacting the market in the short term. Now, by the way, the reason Trump is doing all this stuff is potentially to try and boost the US economy, to try and reduce government debt over there, and to try and make the rest of the world pay for having US as the big brother. So we've had this change from the US as this paternalistic big brother that protects its allies in a nice way to saying, hang on, you guys haven't paid us for that. It's time to pay up. The US spends more on defense than the next 25 countries, including all its allies. So you can argue that maybe that's fair, that somehow we should all have to pay a bit more for that protection that we all would rely on. And the tariffs is a more complex thing, but it's the craziness of which Trump goes about it, which is causing a little bit of ups and downs on the markets and the unexpected nature of what he does, where the market doesn't quite know what to do next. Now, no matter what he does, it's not going to cause massive crashes. The crashes, as we know, come from when we've had a boom. We certainly weren't in a crazy boom. There's room for some more downturn. You can never say never on the craziness, but it's unlikely to drop substantially. And this will be an opportunity to, as usual, for the patient to hang on and for markets to resume their way. You can still see, even on that right hand top where the market is now, it's still well above where it was a year ago, and well above all the other peaks of the valleys. So I just thought I'd re-emphasize, and no opinion from me here. This came from Time Magazine. The picture of Trump on the roller coaster, highly appropriate. But the roller coaster in markets actually provides some benefits. It takes the heat out of the market. I thought I'd remind us the 6 ways in which our process reduces volatility because we allow for it. We know it's normal. We know it's completely the only certainty in the share market is volatility. So how does the care process reduce volatility? Firstly, with the massive diversification, we reduce risk. So that means we've got money in Europe, we've got money in emerging markets in China. So as the US eases, some of these things are actually picking up. So that helps some parts of the portfolio. That diversification gives us opportunity for number 2 here for rebalancing. So when when something goes down, we will buy more of it to balance get the portfolios back to balance. And if something goes up, we'll sell a little bit of it. The easiest way to explain this, to think about it, is during COVID, we had share markets drop 36% in less than a month. So we rebalanced. That means we bought more shares and sold defensive assets. And then within a month, the market was pretty much back. So we were selling shares and buying defensive assets. So that enabled a profit in a market that went sideways. So went down, went up, rebalancing during those dips creates opportunity. We've taken a tactical position in the active portfolio. So just before this downturn, or just at the start of it, we tapped out of US shares and Australian shareholdings there. So we went to cash in the active portfolio. We only do these types of things in the active portfolio because we want the long-term strategic portfolios to be always in the market. We use rebalancing in those, but for the active portfolio, it deliberately from time to time will take profit. And to show you an example, that active portfolio over the last 10 years has had a 9.62% return. So higher than anything else there. And we've only made about 3 or 4 decisions there to take profits. We've made another one. We'll see how that pans out. We'll probably buy in at some stage if the market gets a bit lower, or when it starts to go back up. So either way, we've reduced volatility and probably made a profit. That's hard to do. So you've got to make 2 good decisions. We don't take these things lightly. So we'd rather be in the market in the long run. When you look at markets like this, you want to be in by default, and you very rarely want to be out. So the third way Care adds value during volatile markets, sorry, the fourth way is the reserves portfolio. So for all our retired clients, we've been topping up the reserves over the last year as markets have been high. That means we've got plenty of cash in the cupboard, so to speak, which allows us for any long periods of downturns, which means you get paid out of that reserves portfolio, which means you never have to sell good assets at a bad time. And for all our wealth accumulators who are dollar cost averaging, we're buying the dips here, which means we get the chance to buy shares on special. Both those strategies are better than trying to be out of the market completely, which is incredibly hard to time. And the Money on the Move framework, where we have this dial for those clients that are new or coming in or out of the market, it just provides a way of spreading the risk. And knowing that we put money in slower when markets are high and quicker when markets are more fair value or under fair value. And that also factors into when we rebalance as well. So as I said, we've notched that down a bit to about an 8. Market's just a little bit above fair value. We've got fair value of the Australian market about 7.6 to 7.8, and it's sitting at about 7.9 at the moment. So getting closer to that level. Why do I show this every month? Because it's very important what government bonds are doing. Government bonds are the risk-free return. We can see in Australia, 10-year government bond rates have bumped up a fraction to just under 4.5%. In the States, they're still at the high end of the last year. The red line, sorry, the purple line on both these is 12 months ago. And if we were to see any real scariness in governments, whether it's the US with Trump or anything else, you'll see bond prices go up. And when you'll see bond yields go up. And when bond yields go up, that's the interest rates, that will cause other assets tend to go down, like shares. But also the flip side is also a real thing as well. If markets calmed, and if it was deemed that the riskiness comes out of the market, there's certainly room for bond rates to drop 0.5%, down closer to the 3.5 to 4 where they were 6 months ago, and that would see a boost in share prices, etc. Now let's go, as I've talked a bit about this already, so the market context and our wall of worry framework. I won't touch on that. It's always good to see. So we've just been through a 10% downturn. That's a correction. All these major declines, the 9 major declines since 1900, so 125 years, have occurred after a boom, but they've been proper bear markets, which are more than 20%, and these 9 more than 22%. So we're not even close to that. A 10% correction kind of happens almost every year in that range somewhere, or pretty close to it. I've updated once again. I've left this. The market's so got a short-term focus at the moment, and the single obsession is the T word. what's he done? What's he said? I've never seen anything like it. I don't think, but we do have a tendency to forget. That's why I'm reminding us all about the behavioral bias of recency bias, whatever is happening right now. We tend to think has way more importance than things that happened in the past. And I was watching a movie somewhere recently. It was set back in the 60s, and it was when JFK had the finger on the button, was just about to fire nuclear weapons at Russia, and the world was at standoff. So the world goes through some pretty volatile times. Once they're solved, we forget very quickly. So when the next big thing appears, we think it's bigger than anything that's happened before, and it usually isn't. This too will pass. And recency bias helps us to just remind ourselves that this news isn't necessarily bigger than anything else before. In the 4 pillars of our investment strategy, I've highlighted today 2 from here, as always. So 1 on investor behavior, that avoiding bad decisions. There's a tendency, and even in the media, I've seen some journalists saying they're cashed up and selling all their shares to buy back when the market crashes. That almost never happens. They've got to make 2 perfect decisions. You don't want to be out of the market unless you've got another use for that money, buying a house, giving the kids or whatever. In the long run, the market goes up more than anything else. So avoiding bad decisions of panicking is huge. And obviously, volatility is inevitable. It's normal. It's perfectly predictable, yet of course unpredictable at the same time. It's just part of the market. So let's have a look at individual asset classes. So you'll see here at the crosshairs, the market in Australian shares had dropped, but it's dropped again, about the same level. So down about 3% for the month, 3.8% to be precise, and down about the same to the bottom of that trough, and then it's bounced up a little bit from there, but still under pressure. When we look at the long term, 10-year returns of about 7.45%, which has enabled that market to deliver 22,000 on a $10,000 investment 10 years ago. US shares not down as much with adjustments in the Aussie dollars, certainly, and this was because the Aussie dollar dropped a little bit. That cushioned the downturn, so you can see, but it has dropped a bit more post the end of the month. So we'll see, and the Aussie dollar didn't drop at that point, so we will bear the brunt of that 3 to 4% for March. But long term, just it's been such a good ride in US shares. When you look at the companies that make that up, from Apple, Microsoft, Nvidia, Amazon, Meta, which is Facebook, Alphabet, which is Google, Berkshire Hathaway, which is Warren Buffett, and then the others. It's a great place to be. It's still where the world drives a lot of profits, and is likely to be for a long run. This downturn has helped to even up things a bit, and US fund managers are sending a bit of money out of the country to Europe, emerging markets, China, etc. as well, which is good for the other bits of the portfolio. Global leaders, much the same story. $10,000 10 years ago, it's grown to about 30,900. Stellar, 14% 10-year return. But you can see the same story, downturn since the end of March, end of February, but nothing crazy. US small caps have felt the brunt a bit like Australian shares. They're down 5% for February, and then about another 3 to 4. Still a 10-year average of about 10.68%, and even 1 year 10.98%. This is the real engine room of the US economy. It's where companies that we've never heard of are out there making a buck. And these are big companies as well, even though they're small caps in the US. They'd be top 100 in the Australian market. So then emerging markets, and you'll see it's gone up. So emerging markets has actually gone up. It was down a little bit. So it was up in February 1%, and then it's jumped another 1%. And that's this rotation. This is why diversification is so important. And you see all of a sudden, 1-year returns on emerging markets, 15%. After dragging for a few years, it's now taking its turn to deliver some profits in the active portfolio. And we definitely did not get out of that one. We kept that one, fully expecting emerging markets to be strong at this period. Gold, also incredible, 46.72% for the last 12 months. So just amazing, and you'll see it going up. Gold loves volatility. It loves bad news. You never want a portfolio of just gold because it doesn't produce any income, but it plays a really important part in the portfolio. And it's delivered a stellar result. Not as much in the last 10 years, but certainly, yeah, in the last 5 years. So let's look at property, and in this one, we talk about our boom bust boring. We've had a strong property run since COVID and just before for some. I'll put that in perspective in a minute. So we've seen, annual returns muted, except for Adelaide, Perth, Brizzy. So we're 9% in Brisbane over a year, 12% in Adelaide, 14% in Perth. The rest of the country pretty flat. As you get down to the quarter, it's pretty much flat everywhere. 1% in Adelaide's the biggest. Nothing terrible. The downside, Melbourne -1%, and very muted on the 1 month. I thought I'd throw in some interesting data this month. You look at the percentage of units in different cities, and you'll see Sydney has the most units, followed by Darwin, which is fascinating. Then the ACT, then Melbourne. Melbourne quite a bit lower than Sydney in terms of units, and obviously less units as you get out into regional. Australia, one of the solutions for no one likes talking about this, but one of the solutions for the housing crisis is to thicken up our regions and obviously units in towns, but obviously there needs to be jobs there, etc. as well. So this research from SQM was really interesting as well. It shows the asking prices right now. So what's the average of asking prices right now? So 1.9 million for Sydney houses. And that's against a backdrop of a median value of 1.1. So it tells you where the future's going as well. And units about 840, so 1.5 combined. Big drop to Melbourne, average 1.2, but they're pretty much all at $1 million, except for Hobart at 813, Darwin at 734. All the other capital cities well over $1 million for that asking price. So if you're looking for properties, that's the average. Obviously, it's lower for units, down as low as 400,000 for Darwin, Melbourne 621, Canberra 592, Adelaide 529, Hobart 500. So that's a potential good first investments for people, or it's also the first home buyers market. I come across this article from Michael Matusik, who I've known and respected for a good 20 years. He's got an astute analysis of the property market. And I just like this thing about what contributes to a housing boom. One is population growth. It makes sense. More people moving to an area will boost demand. Second, employment growth. So if an economy is going well, we've seen this in Perth. It's been part of what's driven the last 5 years. And that's hand in hand with real wages. As wages go up, that means people can spend more on rent and mortgages. Tight supply. So if we've got a shortage, house price will go up. Undervalued housing. So when housing's down long enough, relative to other areas, that will cause a boom as well. So we've seen that in Perth. Perth was underweighted for years. It's caught up now, same as Adelaide. Adelaide's caught up. You could argue Melbourne's right in that mix right now of being undervalued because it's been weak for the last 5 years. So Melbourne's starting to come to that zone. I'll talk about that property clock in a minute, and also whether the young buyers are going. I think for any of you that have been around for a while, if you've been buying in Australia for the last 40 years, where young people have been buying, done incredibly well. And I still think that's a good guide for investment properties. And education, close to schools, universities, that type of thing. And then, as always, an X factor, whatever it is, or economic shifts. COVID was the biggest X factor we've seen. It prompted people to relocate, more regional, more lifestyle properties. And Michael's opinion here, while some areas still may boom, the post-COVID surge is unlikely to repeat. Doesn't mean it won't go up, but it'll probably go up a lot more gently. Mortgage rates, no change. So the market's still waiting. There was a brief drop a couple of months ago when we dropped the rate. Rates dropped from about 6.2 down to about 6. So, but since then, and keep in mind, this is the 6.71 here is the headline variable rate. Nearly every bank will have a special that's about 0.7 lower than this at 6%. So if you're paying 6.7 now, you should be renegotiating with your bank or refinancing. 0.75% on $1 million is $7,500 a year. It's a big number, so it's something to stay sharp on. As I said before, if you need some help with that, yell out. We've got some great mortgage teams that we work with that can help you on that. I thought I'd show last month's and this month's of Performance Properties property clock, and you'll see not a great deal of changes, but the big one that stood out for me was Melbourne now starting to enter that buy value zone. And that's where it's starting to look like good value. Doesn't mean it's going to go up massive amounts straight away, but from buy value eventually gets buy momentum. And we've seen them move a few places forward a bit. So Perth is still in that buy momentum. Brisbane and the sunny coast closer to home for us, still at that hold or peak end. I must note they've wound the clock back a couple of times there on the Sunshine Coast because it keeps growing a new life with more and more internal immigration, particularly money coming from Sydney or Melbourne. So interesting. As always, there's always somewhere to buy for people looking for investment properties if they look at the fundamentals. And for those that need a hand with that, we do work together with Performance Property on helping our clients find good properties, something that's worked well for those, particularly that have bought the last 5 years, particularly around Perth, where we've seen really good gains over that time. And just in closing, thank you for listening. But yeah, we just work off 4 long-term beliefs and sound principles. The first of which is all investing best done as part of a real financial plan, where you've got goals based on what's important to you. Portfolio designed to meet those goals. We take a long-term view. That allows us to ride through the noise, like at the moment. But we do have a lot of strategies that will deal with that noise that I've talked about. But diversification, asset allocation, equally, we take a low-cost index approach for most gross markets, unless there's a good reason not to, which occasionally there is. We protect against short-term volatility through that reserves and dollar cost averaging, rebalance regularly. And as I'll remind again, there's only 3 ways to lose money on the market, which none of our clients do. That is panic and selling, having to sell, and not properly diversified. Your portfolios are massively diversified. At the moment, the reserves are full. It's a great time for dollar cost averaging. The world is interesting, that's for sure, but certainly no alarm on the long-term wealth creation. Thank you for your time, and I look forward to talking soon.